Afternoon, everybody, or good morning, depending on where you are in Australia. Hello, Anna. Good morning, good afternoon.
Hi, Liam. Hi, everyone. Welcome to our webinar. We're going to wait for a few more minutes for people to join, and then we're going to kick off.
Thanks to those who've popped in. Some were even early this morning, waiting to hop on, and thanks for those who are popping in now during your lunch break. Appreciate having you as an audience for today. We're really excited about this one, I think, Anna. It's a bit more niche, probably doesn't cover, or it doesn't apply to many of the entities under ASRS, but I think we're looking forward to kind of diving into it because it's very specific and very much required for those maybe 10 or 15% of entities that are going to fall under ASRS with significant investments. Really looking forward to it. Just give it a couple more minutes and dive in. Anna, while we're waiting for the final attendees to join over the next minute or two, any kind of initial thoughts you want to start with on today's call? Any kind of summary themes that you think go through all of the CAT 15 calculations that we're required to do?
Well, I guess Scope 3 in itself is a big topic, and it can also be a bit daunting. And I think out of all the Scope 3 categories, finance emissions, I'd probably call the dark horse. It has its own complexities. I think the two categories that have the most of their own, not so much complexities, but the most topics that are contained within single categories is franchises and financed emissions. So franchise emissions are essentially a whole separate assessment of franchise companies, and financed emissions has a completely different take on things. It's not so much about what activity am I causing through purchasing or through acting as a company. It's more like what activity am I supporting through financial support and investments. And it's it's a slightly different take on emissions. So I think it's a very interesting one to talk about.
Yeah, I think great point. I think it is slightly different. I think the first 13 categories, it's fairly straightforward in terms of the way we would approach those. And this one, very, very different. I think my overall message for everyone on the call is that there's data gaps everywhere. Everyone we work with on this is missing some data or needs to fill gaps with other data. And every kind of calculation we make under this category requires a bit of problem solving. But the goal is, as always, to do that in a way that makes life as easy as possible and gets us as close as possible to accurate results. I think we've got enough people on the call, Anna, for us to kick off now. We're a few minutes in.
Let's kick off.
So let's do it. I think obviously financed emissions under ASRS, a deep dive into Scope 3 category 15. Arne, would you like to take us through a bit of an agenda to start with?
Yeah, so welcome everyone to our webinar for those that just recently just joined. So I've got Liam on the call and me. My name is Arne Geschke. I'm the co-founder and chief data officer here at Fair Supply. And today we're going to be talking about category 15, a very specialized focused webinar on financed emissions in their own Scope 3 category. I'm not going to read out the agenda. You can read it yourself. So we're just going to maybe go one slide further, Liam.
Let's do it. We've introduced I'm Liam, by the way. I'm a head of customer success here at Fair Supply. Lovely to see some of our customers on the call, recognize your names. Look forward to catching up with you again shortly. And I take our customers through all of our emissions measurements projects with Anna's support and our team's support. So looking forward to talking through it all with you.
Yeah, then we have our usual disclaimer. That's because my co-founder is a lawyer. So we have disclaimers in our presentations. I assume you've read all these and we can kick on. So let's talk a little bit about the introduction. So what are financed emissions? Financed emissions is essentially, it's almost one step removed from any kind of activity or production-based emissions or like consumption-based emissions. So financed emissions is all the emissions that are attributed with the lending and investment activities. And they are calculated, they're often they're built on top of already work that's already been done around Scope 3 emissions. So we need to understand what the emissions of the investee company or the entity that we are financing is, and then a certain proportion of the emissions of that entity is attributed to the lending company or the bank, whatever, whoever is providing the financing. And this kind of take on Scope 3 emissions, I think the first thing that pops into mind is like, are we double counting in some way? And the Greenhouse Gas Protocol says, yes, we are. So the emissions, of course, pop up for the reporting entity that we are financing, and they're also the same emissions pop up to a certain degree, whether on the emissions sheet of the entity that is financing the company. So that is intended, and the reason why this is intended is because financing is a significant lever in making purposeful decisions going forward. So if financing money is withdrawn from certain activities due to their high exposure to Scope 3 or emissions in general, and this is a very powerful lever to convince companies to work on their carbon mitigation strategies so that they become more attractive for investment. So it's a very important lever to understand.
And a similar lever, I think, that we see in insured emissions too, right, Arne? Same kind of concept for us as well, and that we're less connected to those goods and services that we purchase and more connected to the kind of ability to invest or ability to insure, to enable a project to either start or continue. So yeah, really, really interesting.
Yeah, and there's a whole bunch of if you are working in a space where you are in a financial institution, the finance emissions can be a significant part of your Scope 3 emissions. So you could say that any major bank in Australia would probably find that Scope 3 category 15 is one of the main ones to look at. So how does it all fit together with AASBS2, the Greenhouse Gas Protocol, and PCAF? So AASBS2 adopts the Greenhouse Gas Protocol, so it means it also adopts category 15 of the Scope 3 assessments. So the Scope 3, if you go through the calculation guidelines for category 15 and the Scope 3 guidelines in general, they fall a little bit short from really explaining what needs to be done in order to have a full coverage of financed emissions. They mention them, but they don't give us all the details. So there's a second standard that sits on top of the Greenhouse Gas Protocol, and that's called PCAF. The PCAF standard really drills down into how financed emissions are assessed, accounted for, and interpreted. Next slide, please. So it is, again, like we love abbreviations in this field. So PCAF stands for Partnership for Carbon Accounting Financials, and it is built, as I said, on top of the Greenhouse Gas Protocol. You can see these two documents always like next to each other because they really depend on one another. I would say the Greenhouse Gas Protocol is probably always a little bit ahead of PCAF. And over the last few years, we've seen PCAF really develop. So, for example, in previous versions of PCAF 2 or 3 years ago, there were certain categories or asset classes that were simply not defined at that point that still had to be developed. We've now moved along a little bit further, but there's still parts, for example, in consumer financing where PCAF simply hasn't defined the standard yet. So this is still an evolving field.
And I think for customers that we work with in this space, this is probably what causes a little bit more confusion than the other 13, 14 Scope 3 categories, is that while we follow the GHG protocol quite specifically to calculate in those standard categories, all of a sudden we're faced with a different standard for a different category of that. But at its essence, PCAF is really just a often more detailed explanation for how to calculate emissions per asset class that we need to follow. So Arne, any commentary on that kind of confusion between the two standards?
Well, I think like you can make it as confusing as you want to because it is a complex field. But what I think for me the simplest the simplest explanation was always that the standard Greenhouse Gas Protocol Scope 3 categories, purchase goods and services and capital goods in particular, they essentially follow the money when it's spent. But the effects that money has that when it is spent is different than from the effects of money that is invested. So spending $1 million in a company has a completely different impact than investing $1 million into the same company. And the PCAF standard essentially bridges that gap to explain the two and to link them.
Wonderful. Thank you so much.
So the 4 pillars, why do we need to measure financed emissions? I think it's really important to take a step back with everything Scope 3 assessing and everything. Often we look at this very much from a compliance lens. there's, I think, at least two more lenses that we should keep in mind. The first one is very important. So it was a little bit not so much idealistic, although it could sound like it. We're doing this to reduce the impact on the planet. And this is not just because we are nice people or we identify with tree huggers, whatever you want to call it. There's a very serious, almost selfish interest that we have in maintaining a stable environment around us, because our life, our livelihoods, our economy, our source of income depends to a very large part on functioning, predictable ecosystems around us. Imagine a world in which we have a lot less predictable cyclone events every year, where certain industries are affected on like maybe even like every few years by significant weather events that have significantly changed patterns from compared to the past. This puts a lot of volatility into our markets, and we don't want to essentially cruise too close to the edge, because it just makes the entire society and the economy very volatile. The second part is that we're actually seeing more and more now that companies around the world are gaining a very strong competitive advantage if they're good at emissions reporting, if they're good at understanding their ESG exposure, because it preps them to enter new markets quickly. For example, if you think of the carbon border adjustment mechanisms in Europe, if you want to enter that market and you may be in competition with another company also from Australia who wants to enter that market, if you are good at assessing your ESG risk, if you understand your scope 3, there's one less barrier to enter that market. And there's a bunch of ESG legislations around the world that are in effect that operate in very attractive markets. And we see more and more that companies identify that being good at ESG actually unlocks revenue. And then, of course, we have those 4 pillars that we have here. So we want to understand that we will have the transparency. We want to create an overview of the financial risk and be able to manage that. And then we can inform strategy and products, and most importantly, track progress over time. So tracking progress over time could be internal targets, but it could be extended all the way to a net zero drive, or maybe changing investment strategies. And so it's very important to keep in mind, this is not just a regulation exercise. We're doing this for selfish reasons to preserve economic prosperity going forward. So there's a lot in the PCAF standard. We can't cover it all today. We're covering the largest part today. So we're covering financed emissions. So facilitated emissions and insurance associated emissions are their own topics, and an hour is simply not enough to go through all of them. But we're covering the largest one that we have.
And Arne, I think our message on that, there's lots to cover. If you do want to catch up with us to talk about some of these specific measurements, please just let us know. Every single one of these is a problem to be solved, and we could do an hour-long webinar on each of them, I think, but it doesn't mean we don't want to talk about them. If you do want to catch up to talk about project insurance or motor lines or whatever that might be, Arne and I will make ourselves available to you. Of course, please, Arne, continue.
Yeah, next slide, please. So the finance emissions part, as I mentioned before, is still evolving. It's still an evolving part of this entire reporting universe that we're living in. It is always built on the greenhouse gas protocol, and it only works if the underlying asset that you are reporting on in terms of finance emissions you have some sort of visibility over the emissions of that asset. There are ways to have like hands-off assessment in terms of understanding what are the emissions for example, if you are financing 2 million homes on the east coast of Australia, it's almost virtually impossible to go in and ask each individual homeowner what is their electricity consumption and do they have solar panels on their roof. There are data sources that help in those kinds of situations, but the idea is always follow the money. If there's an investment that enables or that funds a certain activity, we want to understand what that unlocks in terms of economic activity and the associated emissions. So, but this underlying, and maybe we're moving out of that space now, the fourth point, depending on the sector reporting maturity. I think a few years ago, we still had a situation where certain sectors were kind of steaming ahead, and they were working on their ability to report on their emissions. And there was often a focus on scope 1 and 2 first, and scope 3 came later. We've moved on a little bit now with the AASB 2 coming out, where there's an expectation that, like, across all sectors, there is a certain maturity in terms of scope 1, scope 2, scope 3. But the PCAF protocol is a bit more careful, and PCAF standards still say we are very much relying on the underlying sector reporting maturity. So if the underlying sector doesn't have much reporting maturity, you can't expect the financing part that sits on top of that to have a higher level of maturity. So, and that drives the underlying data availability and the methodologies. And there's a bunch of ways to really zero in and balance these conflicting situations of what do I need to report, what do I want to report, is this a material exposure that I have, and what is my data access? And to guide you through this maze, that's what we want to run this webinar. Next slide, please. So currently, PCAF covers 10 asset classes. We don't have time to go through all of them today, but the good news is the idea of how you report on these is pretty much the same. There's always understand the emissions of the asset and then have an attribution factor, what's called an attribution factor. So how much of the overall emissions belong to the financing activity that we're assessing here. So that's why we're not going in detail through all of these, but we picked out a few that are probably more on people's minds. But again, this is like still evolving. I remember last time, a few years ago, when we looked into this for the first time, we only had 7 asset classes that were covered by the PCAF standards, and now we've moved up to 10.
I think that's an interesting point you made at the start, Arne, about those data gaps and how that feeds into these 10 asset classes. I think for really every single one of these asset classes, when we run measurement projects, we're always starting with that initial assessment that says, what does perfect look like and how far can we get to that point and what do we need to fill in the gaps? So the same approach really applies for us for every asset class. I think a lot of customers we work with, there ends up being a bit of confusion and stress over the fact that we can't get perfect data, and that mortgage data was a perfect example there, where we simply can't know energy usage from houses that we fund through our mortgages, but we can, of course, use things like climate zone data and square meterage data to inform that, and then hope over time that our data improves. So again, we always talk about this, don't let perfect be the enemy of good, and I think that applies really, really well to emissions measurement here too. And when we look at the kind of core principles of PCAF, I think that becomes more and more clear. So Arne, please feel free to continue.
So yeah, if we dive into the actual core principles, so you can see here these 2 kind of columns. On the left-hand side, we have the Greenhouse Gas Protocol, and on the right-hand side, we have the PCAF standards. And there's a shared philosophy around this. So the Greenhouse Gas Protocol says we want completeness, but we don't necessarily need to have perfect completeness, but we want to get somewhere. There needs to be consistency. It needs to be relevant. A certain accuracy needs to be there. But if there's a hindrance and there's like just not the access to the amount of data you need to be 100% accurate for all the exposures, then the Greenhouse Gas Protocol very much states that we're not doing this to present the most beautiful, accurate greenhouse gas emission spreadsheet. If there is a certain amount of inaccuracy, but it still helps us to initiate the right actions to mitigate emissions or to be compliant, then that's very much part of the deal, as long as we are transparent. And that's the last point here. So if there are problems in terms of assessing emissions, in a supplier context, some of our customers have suppliers in Australia to give them detailed information. As long as
Not sure if that's Arne having connection issues or me on my side. We'll just see what we can work out from there. Bear with me for 1 second, team.
Can you still hear me, Liam?
Yeah, I think you just dropped out for about 20 seconds or so, but that's Australian internet. So I think we've got you back, and you're looking and sounding clear now. You're all good.
Okay, cool. Sorry about that. I'm not sure. I should theoretically be in a fairly quick internet connection. Not sure what happened there, but I'm probably not going to repeat everything I just said. I said I wanted to talk through that the Greenhouse Gas Protocol wanted to essentially prescribes us to find a way that what we do is meaningful. That doesn't mean we have to be 100% accurate, but we have to be transparent in terms of when it was just almost out of proportion to maybe dive deeper into certain emissions, maybe because they weren't material, maybe because access to data was hard. And the PCAF standards follow pretty much the same way. So we're going to dive into formulas in a minute. But for example, if there is simply no way to assess the exact emissions of each asset that the investment went into, then the PCAF protocol also has different classes of data quality standards, you could say, in order to make sure that you can complete your assessment, but you don't waste your entire year and all the resources you have set aside for this just to get to the best number possible. We always want to find a meaningful balance, that this is a meaningful exercise that gets us along the right track. And when you think back to those 4 pillars I talked about before, we want to understand and track our financed emissions and also be able to assess improvement over time. So those are the reasons why we do this. We're not doing this to get to the most detailed data point at all times. Next slide, please. So this is the central concept is really fairly straightforward. The financed emissions are essentially the annual emissions of the borrower or the investee combined with an attribution factor. So if you, for example, finance somebody's home and the value of the home at the point of when the mortgage was established was $1 million and the mortgage is only 500,000, then you, of course, then not all the emissions coming from the from living in that home will be sitting under the financed emissions for the home, because only a certain part of that is enabled through the mortgage. So this idea of the attribution factor goes through the entire PCAF protocol. And what we have down here is the general formula with an attribution factor for I believe this is for private equity, the formula. So the attribution factor formula changes every now and like a little bit, but the idea is always the same. I need to have some sort of idea how big my stake or my share in the investee or the borrower's world is. Next slide, please. So again, borrowing the concepts from the Greenhouse Gas Protocol, we would love to have highly reliable data for every single dollar that is invested anywhere or lent out. That's in most cases, I would say in every case, completely impossible, and it also doesn't bring us further in every step. For example, what we see with our customers that run their Scope 3 assessment through purchase goods and services, what we often see is that they have hundreds of suppliers, and 85% of their emissions exposure sits with a very small proportion of those suppliers. So we only dive into that small proportion to improve the data quality, because diving into all the suppliers, it takes a lot of work, but doesn't actually improve the accuracy that much on an overall scale. And it's the same with financed emissions, that we often find that there's certain asset classes that just simply carry a higher exposure. So it's a similar idea that we need to make a call where we want to be, where we need to be more accurate, where we have to put more time in. And so over time, we're hoping to improve the data quality score for each of our asset classes. But the idea is generally we want to get a first overview first, and then we want to improve over time and understand where we need to provide more improvement.
And I think this is a good example of where most of that work gets done over time, isn't it, Arne? I think conceptually, the methodology is similar from asset class to asset class throughout PCAF, and the end result is similar in that we're reporting a specific number. What will change over time, as you've mentioned, is that data quality score as we eventually move from things like sector-based emissions factors and proxies towards more investment or project-specific data points. So that's certainly something I think that changes over time. Very few customers that we've ever worked with have access to score one data straight away to use on all of their different investments. We're usually working on improving that well over time. Shall we talk double counting?
Yeah. Double counting, probably the most notorious of all subjects in Scope 3 accounting is double counting. There's often concerns around, isn't Scope 3 essentially just a bunch of Scope 1 pieces of information that are bundled up? And so is there double counting going on? And the Greenhouse Gas Protocol quite openly states, yes, there is. So for any kind of scope 3 assessment, even from a purchase-based perspective, there is the idea of double counting. So if I assess a car manufacturer and that car manufacturer assesses their supply chains, there's emissions in the scope 3 upstream supply chains that belong to the gearbox manufacturers or the tire manufacturers that are subcon or that are suppliers of the car manufacturer. So the scope 1 emissions of the tire manufacturer would, to a certain degree, also end up in the scope 3 assessment of the car company. That's okay. The greenhouse gas protocol is designed around this situation. It gets actually one step more complicated when it comes to financed emissions, and we have one scenario just noted in that graph there. So imagine there's like two banks, Bank A and Bank B, that finance the steel manufacturer, and Bank B also finances an automotive manufacturer that buys steel from the steel manufacturer. Then Bank B has to assess the emissions of the automotive manufacturer and assess the allocation of that. And these the emissions of the car manufacturer will include upstream scope 3 emissions that belong to the steel manufacturer. Potentially just a small component, but they will still show up twice in the bank's assessment, and that's okay. What we want to do here is we want to create insight, transparency around this, and these attribution rules, they are built around this to essentially allow us to do this. And as long as we explicitly essentially explain what's happening here, this is exactly the intention of the Greenhouse Gas Protocol and PCAF. And there's two schools of thought around this, which I find quite interesting. And one is that the more people report on the same emissions, the more people will try to mitigate those. So that's good. That's one school of thought. The second one is, if we do have a success in emissions reduction, there will actually be several reporting entities that will report that success, because certain emissions parcels will pop up in the scope 3 assessment of different entities. And both of those are valid, but that's the way the Greenhouse Gas Protocol and the PCAF standards are designed. So I'm going to hand over to Liam for some more hands-on examples.
Thank you, everyone. Arne, I think before we start, a quick question from my side on double counting. It's come from customers a few times. Are there any scenarios under CAT 15, if we're following the correct methodology, where we need to consider double counting? My understanding is it's very, very minimal. Whereas when we're running scope 1, 2, and 3 upstream and downstream assessments, excluding investments, we're obviously always looking out for that in terms of our exposure to fuel, electricity, and gas. For CAT 15, a little bit less of a thing to consider if we're following the right methodology. Would you say that's fair?
As in that there's like less of a risk of double counting?
Well, not less of a risk, but it's less of something for us to consider when we're making our calculations in line with the protocol.
I mean, I think that we could probably have an entire webinar just on double counting. I think that's probably, there's intended, I don't think double counting is always the right word in that case, but there's attribution, I would say, attribution of the same of the same emissions parcels to separate entities under the Greenhouse Gas Protocol, and that also stretches out to category 15. I would say double counting is probably a term that should be more used in a sense that that's the way to attribute emissions in a way that it shouldn't be done. So I think as long as the guidelines are followed, then everything is reported as intended, and in that sense, I wouldn't worry any more about category 15 than any other categories.
Wonderful, thank you. As Arne mentioned, we'll talk through a couple of examples today of how we look at calculating financed emissions for the customers that we work with. And as we've said a few times throughout this call, we're always following the same basic framework, which is to look at the emissions that occur within that investment or within that lending portfolio, make the relevant calculations using the best available data. We could talk a little bit about undue cost and effort under ASBS 2 and what that means for kind of finding the best available data, and then applying those calculations and refining from there. So, to take you through step by step, and we'll have some examples of these with different asset classes. Our first port of call is to identify what that asset class is itself. Each asset class has slightly different calculations and attribution formulas required for it. So we need to determine, is this a listed equity, an unlisted equity? Is this project finance? Is this a motor vehicle loan? Is this a mortgage or a group of mortgages? From there, we need to select the correct attribution formula. So really what we're doing there is working out what percentage of that investment or that lending are you responsible for, or are we calculating for in this scenario? Step 3 is always a big one, determining the best available emissions data. I think that for the majority of these asset classes, maybe it'll be different in 5 years' time, we're going to have to rely on some sort of estimation as we go through this process. AASB S2 allows us to use estimation, but as Arne mentioned in a few previous slides, we've got to be really clear and transparent about what method of estimation we used, why we needed to use it, potentially how we seek to address that lack of emissions data in future. And so that's something that is not just relevant for Cat 15, but for really every category of Scope 3. I think for the next few years, at least, there'll be lots of estimation happening across those Scope 3 categories. And the same process applies. We use the best data we have. Where we do need to estimate, we're really transparent about why and how we've done that. And that should make the audit much more simple for everyone. We then apply the calculations and then we refine from there. We might do a few different tests using different data inputs. But refinement can often be an internal piece as well. We might not have the ability to use real data or actual activity data this year, but we know with a few small internal changes over the next 6 months, we can get to a place where we're using actual activity data in future. And Arne, you probably agree that that is helpful. We would want to use real data where humanly possible, because that puts you on a better path for actual reduction and being able to measure that progress over time, whereas using sector-based data or proxies for state grids for electricity usage and energy usage, for example, you can only see change in that aspect if the whole grid changes or the whole sector changes itself. I'll pop on to the next slide. When we talk about identifying the correct asset class, this is always an interesting one for us to go through. There's a whole decision tree that we probably won't go through in detail, Arne, because there's lots of different questions that we need to look at. But there is a structured decision tree that we need to go through to kind of classifying financial exposure into the appropriate asset classes before we calculate financed emissions. I think that most people on this call, most customers we work with, should have a pretty good idea of what asset class these exposures fall into already. You would probably do some significant reporting on that already internally. And for most of the customers we work with, their exposure is in things like listed and unlisted equities, especially if you're a superannuation fund. Or if you're a bank, you might have a pretty large book of business loans, mortgages, car loans, personal loans, and potentially some sort of corporate bonds and similar as part of your investment portfolio too. So while we won't talk about every single one of these today, I think the majority of people that we work with, the majority of people on the call today probably fall into that category. But I think, Arne, we'd love to have a chat about sub-sovereign debt if anyone does happen to have financed emissions from some of those more niche categories. Please do get in touch. We'd be more than happy to talk through that. And so I think we'll look at some samples now. We can look at listed equities and corporate bonds as a specific example of what we look at. So the asset class definition for this, all on balance sheet listed corporate bonds and all on balance sheet listed equity. So common or preferred stocks that are traded on a market like the ASX, for example, and are for general corporate purposes. I find that, and we find that listed equities, it's usually a little bit easier to get actual data. This data is often published in annual reports and sustainability reports. Listed companies may publish their Scope 1 and 2 data for us to use in actual calculations. Unlisted equities, less so, but we'll talk about that shortly. And so the process for this is relatively straightforward. I mean, a two-step process to start with. We want to measure the total annual emissions of the investee company in accordance with the GHG Protocol. Hopefully, that listed equity has already done that. And as we just mentioned, has been published in a report and verified in that report as well. And then we want to attribute a proportional share of those emissions to the reporting financial institution. And so, Arne, when we look at attributing for attribution factors for listed companies, pretty straightforward in terms of the calculation of the attribution factor. Do you want to talk through that and how it differs very, very slightly for bonds to private companies?
Yeah, so like the first time I got in touch with this was in 2015 when I was working on one of the first financed emissions reports from one of the major Australian banks. And the question at that time, the PCAF protocol hadn't advanced this far. And there was a lot of discussion around how this should be done. And those formulas were actually also developed at the time. And yeah, so the attribution factor in this case is the outstanding amount for yeah, and then the EVIC value underneath. So it is essentially everything that the company has in terms of assets and cash, and then versus the amount that is invested. So it's actually quite straightforward in this way. Interestingly, the question is that when I look into this, what happens if the investment profile changes throughout the year? And the PCAF protocol says it is whatever is in the portfolio on reporting day. So if the reporting day is the 31st of December, it's what's in your portfolio on that day. That's what you have to, that's what sits in the finance submissions department for the entire year. So when things fluctuate throughout the year, it actually doesn't matter that much. It's really comes down to what's happening on the day, because otherwise it's really hard to handle.
Fantastic, thank you. I think the challenge we always have, again, we've talked about is determining that available emissions data. So company disclosed emissions data, scope 1 and 2, and where available or where relevant, scope 3 emissions, that might be relevant or material for a company in this space if you invest in a coal mine, for example, and we know that most of the emissions from a coal mine are likely to be in that downstream scope 3 processing or use of those products, in which case it probably would be material to look at disclosing those alongside the financed emissions. If we can't get reported data from an investee company, we'd probably want to look at either using company-specific production or operational data. So are they able to give you the data that leads you to make a conclusion about their scope 1 and 2, their energy usage, their fuel usage, their gas usage? Alternatively, which is something we do a lot, should we look at using revenue or financial data combined with sector emissions factors? So in replacement of having actual data, should we look at sector-specific emissions factors to fill that gap, ideally, while we refine that process? And again, as part of that process for liquid equities and corporate bonds, we would, score those different data quality inputs. When we're talking about using actual verified emissions from a company, we're of course talking about something that falls into score 1, 1A or 1B, actual scope 1 and 2 emissions. We could then move down to look at physical activity-based emissions, and then move further to look at economic activity-based emissions, which we do a lot of work on in terms of specific sector emissions factors. My experience tells me we're usually choosing between option 1 and option 3. There doesn't tend to be a lot of middle ground at the moment that makes it easy to kind of verify activity data that's provided by either a supplier or a company that you invest in. But of course, we want to improve in that space over time, of course. And then we apply the relevant calculations. So relatively straightforward. We've got our company emissions, we've got our attribution factor, we multiply them by each other, we end up with the portion of the finance emissions that we would put in our CAT 15 in this instance. Refining over time is a really, really good example. For most companies reporting under CAT 15, there'll be gaps in the data. That company that you're invested in may not disclose their emissions. They might not be able to get you actual activity or energy usage data or anything that leads you to make a conclusion about scope 1 and 2. So we use emissions factors, and that's Arne, you would probably know as well. It's a perfectly valid use of data for this purpose, but we would want to be transparent about why we've needed to use that data to make that calculation. And we may set a goal that, by year 2 or year 3, we're going to be able to get all of that actual data from the companies that we invest in. But refining over time means different things for different companies, and of course, it's not easy. Some specific examples here, which are relatively straightforward. We end up with an attribution factor after we've done our calculations of 20%. Those company emissions were 250 kilotons. So no spoilers for anyone. That ends up as 50 kilotons of CO2 equivalent for us to put towards our category 15 emissions. And this is likely a pretty easy exercise if you're getting data from a large ASX listed company that publishes detailed sustainability reports and similar for companies listed in other countries. Excuse me if there's any background noise from my toddler who's just arrived home upstairs. When we go through the process of kind of data points for these companies, it's generally a straightforward process. But I think for unlisted, a little bit different. Moving on to project finance now. This is a bit of a fascinating one. Arne, do you want to talk through project finance a little bit? Obviously, we're talking about designated loans or investments for a specific project or a set of activities. There's going to be lots of companies we work with that provide this kind of finance for infrastructure projects, construction, energy related projects across Australia. That's very, very common. So the emission scopes covered here is we're looking at absolute scope 1 and 2 emissions of the project, scope 3 where relevant, and of course we're wanting to avoid or remove emissions that are disclosed separately. Arne, any points you'd like to raise on project finance in particular?
I think the fascinating thing about project finance is this formula at the bottom there. It's actually two formulas. So the one at the bottom says it's the attribution factor is the outstanding amount versus the total project value at origination. And especially during projects, so the example I chose here is a wind farm, because the wind farm goes through a process of construction where the emissions are quite high. And then during its operations, the emissions are fairly low. So there's a few things that happen. Like the emissions are almost front-loaded during the lifetime of the wind farm, and because it is a once-off emissions type thing, the attribution factor changes a little bit, and the emissions are spread out across the entire expected lifetime of the wind farm. The second thing that happens is, as the financing is repaid, the share between how much of the total project value is still in debt and how much is already paid off changes, and in that sense, this side's only looking at the project finance piece where the money is actually lent to the construction company, construction company. That portion of the emissions is actually decreasing over time. So I think this is a really interesting case. You want to go one slide further, Liam, or is it 2 slides further? Yeah, this shows like how essentially the project finance piece goes down over time. As you can see, the attribution to debt decreases over the lifetime of the project, and as such, the project finance emissions per year are actually adjusted according to how much of the loan is outstanding. Interestingly, the reference value of the overall project is always the value at origination. So even if the value of the asset increases over time, that cannot be considered. So if you imagine, the asset is worth $10 million during year 1 and $50 million in year 2, in a way, like relative share that the debt holds of the overall value of the project goes down, which one could argue means that the attributed emissions would also go down. But the PCAF protocol says, no, we're going to freeze that point in time at the beginning of the project. And I think that's what I did here in this example.
Yeah, wind farm's a great example, right? It's definitely something that is commonly financed at the moment. If you are, financing that 50% proportion, and those reported scope 1 and 2 emissions are 120 tonnes, then we're going to look at 50% of 120. It's relatively straightforward for the first part, but like you said, Arne, over time can get a little bit more complicated, but certainly something that it's quite specific for us to look through, and certainly welcome having some more conversations about those. It's always different depending on the customer we work with, but there is a way forward with all of it. This is one we talk about all the time, and we get asked about all the time from the financial institutions that we work with, and that's mortgages. Coming back a little bit to what we spoke about lack of data, I think we all agree that there's no real way for us to real-time track the energy usage of every single house that we have funded, and we probably wouldn't want to do that anyway, and I'm sure the mortgage holders wouldn't want banks to be doing that either. So there is that perfect future state of where all the data comes in and we've got it all and it's perfect. We're halfway there, and we need to use proxies and other sets of data usually to fill in those gaps. But again, the same approach applies. What is the annual operational emissions of the property? So what are the scope 1 and 2 emissions of this investment? What can we attribute towards that using a loan to value approach in this instance? So slightly different to what we looked at before. But really, we're looking at what kind of emissions or what total emissions are we enabling by funding a mortgage. Refinance mortgages are attributed, providing the refinance loan. And for now, construction and renovation emissions are currently excluded. So this is a really, really interesting one where we always probably don't use data that falls into that score of 1 under PCAF, Arne. We're always looking at that 3, 4, or 5 score for what we need to use usually. And so a good example, without going too detailed into formulas, is that we're going to look at an attribution factor based on the outstanding amount of the mortgage versus the value on issue date, which I think is quite interesting based on the way that the Australian housing market increases in value regularly. But a good example being that, we might look at the value on the left-hand side here of a home being $1 million when the loan was issued, and that loan was $600,000, and the bank contributed $450,000 to that. So therefore, we have an attribution factor of 45% in this instance. So if you're a bank on this call and you're preparing to report these numbers, I would start capturing data on these kind of data points. What was the value of the loan, of the house when the loan was issued? What was the size of the mortgage that we offered out? And what was that outstanding amount on the reporting date? So all of these kind of data points can be done in bulk. And that gets us a kind of attribution factor per mortgage, right? Which, Arne, I think you'd agree is fairly straightforward. 3 or 4 data points at the most that most organizations here should have, or I'm sure will have. And that's the easy part. We then get into the point where we need to plug in emissions data. Now, we, of course, cannot call up every homeowner. That would be certainly undue cost and effort, and no one wants to go through that process of understanding actual energy usage. So we can use data sources that are available that plug that gap. Now, for some projects, you might use climate zone data, so using the postcode, which gives us an idea of average energy usage for that postcode in particular. We recently ran a large-scale project where we were looking at emissions across about 6,000 different homes in the Greater Sydney region, and we decided we could get better data utilizing average kilowatt hour usage per postcode. So that was what we ended up utilizing, which is similar to kind of climate zone data, because that customer of ours had data that told us whether the property had gas or not, right? So we can refine over time to try and get slightly better data. And that, I think, is a worthwhile exercise, because we're not then attributing an average gas usage across every single property. And that gives us a goal in moving forward to potentially convert some houses from gas to solar, and we can actually work with that number. But for many customers and for many organizations, we might just be looking at blanket postcode or LGA-based data or council-based data. That's not a problem, but something we'll need to do to start with. And then moving forward, maybe we're able to gain more information about what type of energy generation is happening at the household and whether they have solar or whether they use gas or not. So I think this is a really, really crucial piece. This is a common piece. Arne, do you want to talk through very, very quickly how that would differ from things like business finance or car finance we hear a lot of too? And, again, I think cars is a fascinating one because it basically follows the same process here, except instead of using energy usage from a home, we're going to look at lifetime emissions from a particular vehicle. But any thoughts you had on that particular?
Well, generally in mortgages, I think what I find interesting here is, again, this concept that we want to report emissions on an annual basis, but any kind of financing activity usually has a longer lifespan than just a year, and things change throughout the year. So we had that in the beginning at the when we talked about the listed equities or the listed assets, that there's a point in time when the portfolio is essentially assessed, and then the decision is made. This is what goes into the assessment. So that was the reporting date. And with mortgages, it's almost like quite similar. So many of us on the call probably have mortgages that last for several decades, at least on paper, unless we're able to shorten that time frame somehow. And that things change along the way. And so the PCAF protocol has to maneuver these kinds of tensions. So the house value goes up, the home value goes up over time, but the overall loan amount will of course stay the same. The outstanding amount will hopefully decrease. Those kinds of things need to be considered. And there's there's sometimes a tension between almost like, do I want to refinance because it looks better on paper? Because if you imagine that you have $450,000 outstanding, the home value is now 1.2 million. If you refinance that, then your attribution factor would go down. So the intention is obviously to understand financed emissions, but sometimes the guidelines, they unfortunately also need to that they do create almost like incentives to maybe employ a little bit of a numbers game to get the attribution factor down. So that's why we have to keep in mind while we're doing this. We're doing this to have to create the transparency around this, so we can actually have a positive impact. So I think it will be interesting to see going forward, and we haven't covered that in this slide deck here, is things like for example, the financing of green projects also creates, for example, emission certificates by the abatement of certain emissions going forward. So I wonder if we're going to see a refinement, especially in things like mortgages, where maybe houses with a certain energy standard receive a different attribution factor, or things like solar panels on the roof and solar hot water systems can be considered in much more detail for these kinds of assessments, because they do make a huge difference. But if we have only sort of a blanket type approach to understanding the energy use of those houses, we don't get down to that level of detail. So it'll be interesting to see as we roll out AASBS2 whether maybe financial institutions will pivot towards incentivizing homeowners to employ low carbon energy solutions, because that would knock through to the financed emissions on the balance sheet for the financial institution, which is exactly the intention of what we're trying to achieve here. So it'll be interesting to see how this field changes.
Absolutely. Yeah, I think there'll be lots more to discuss over time, especially as Australia moves more towards kind of renewables in the future, as it has continued to do. One thing we haven't talked about today that we could probably do an entire other webinar on is insured emissions, which also falls into Cat 15, which is very, very, I want to say very, very different to what we've talked about here, but again is another example of calculating for emissions that aren't simply connected to what you've bought or sold as an organization. So similar to financed emissions, in that we're seeing insurance as a lever to enable projects to start and continue and to excel. And generally speaking, when we're looking at insured emissions, we're looking at that share of risk that an insurer takes on and multiplying that by the emissions from that project, right? So you can imagine that those insured emissions numbers increase dramatically if you're insuring 20% of a coal mine or of a steel manufacturing facility, and you're therefore attributing 20% of those emissions to your insured emissions. That number is going to increase really drastically. There's a whole bunch of other ways we can calculate that space. So certainly welcome being able to discuss that with others, but we're not going to go into that in detail today. Arne, anything you'd like to add about insured emissions? I just thought it was important we brought it up as one of those things that is a regular task for us as well, that sits within this group, but probably requires a bit of a different approach to the kind of asset class attribution factor approach that we've talked about on today's call.
Yeah, I guess like everyone on this call can probably appreciate that we can talk about this for literally hours. So we've picked out 3 asset classes just from the finance emissions for this talk. With the insured emissions, it's similar. There's an attribution factor. There's like an understanding of what the emissions are that are essentially, you could say, the activity that is enabled through the insurance process. And then we need to understand what the attribution factor is, and that's what's then the insured emissions. But it is, I think, I guess the overall message for whether it's insured emissions or financed emissions or any kind of scope 3 category 15 is that there is a way through this. If you set up the right processes from the start, what Liam covered from at the very beginning, setting up the right process now, getting on top of things, and then refining over time. That's essentially the message that we would like to get across. It's like this can all be done if we start from the right position, essentially.
Wonderful. So I guess the big question then is, what do we do about the problem of Cat 15? Again, we will always go through the process that's required as per the GHG Protocol and PCAF, but our job is to save those hundreds of hours that would usually be done manually. So for those hundreds of listed equities or unlisted equities that you have that you can't get data on, we can plug in those compliant emissions factors using the relevant data points, apply the attribution factors to get that output quite quickly so that we can calculate for those. We will always encourage the use of real data, but where we don't have real data, we'll use sector-specific data and save those kind of huge amounts of administrative tasks. Same thing applies when we're looking at mortgage loans as well. Arne and I will do a lot of work to ensure we have all of those average energy usage kind of data points for things like electricity, gas, water for the home, so that when you're providing us, or when customers provide us with a list of 20,000 mortgages across 600 different postcodes, we're able to plug that in and save as much time as possible to estimate energy usage and therefore, finance emissions based on those mortgages. The same things apply for vehicles and all sorts of other different asset classes. So for us, that's certainly where we see the fair supply solution as being the main problem solver in this scenario. But we manage these projects end to end as well. Arne and I, when we're going through this process, we will always look for where can we find the best success with using actual scope 1 and 2 data so that we can get on the path of reduction and measurement of that reduction in a meaningful way over time. But the reality is for so many organizations that you are going to have to use kind of plug and play data for probably thousands of different entries. And we want to support that and do support that initiative in a way that saves many, many, many hours of work. So again, I think another thing to call out is our ASRS email mini course. Please feel free to sign up for this one. Fantastic use of practical resources and checklists and chapters and all of those kind of fun things to learn more and more about ASRS in particular. Now, there's only 5 minutes left. Louise has just put forward a question there to Arne, which I haven't had a chance to read yet on the call. Not sure if we've got an answer for that one or if we want to take it offline and get back to it.
Yeah, I'm just like, thanks for that question. And that's, I love it because it's really detailed already. I think, are you able to elaborate a little bit on that in terms of to clarify what you mean with like other capital providers? We can maybe also turn your mic on, might be easier. Otherwise, we can take the conversation.
Yeah. Hi. Yeah, I understand the changes in December meant that, say there's a company with both thermal and renewable generation. If the renewable generation is funded with green loans, those green loans, the financed emissions for them will simply reflect the emissions from the underlying assets, being, the renewable energy. And instead of what used to happen would be those funders of the green loan would just take their percent of total capital. So their emissions might go from, quite large to zero. Mm-hmm. What happens? So obviously there's a bigger pool of emissions for the other capital providers to include in their financed emissions now. How do they know, in the absence of seeing the reports from the green loan providers, how do they know what emissions they should be reporting against all the other assets?
I don't know if I can answer that in detail right here. I think that's like a bit specialized.
Sorry,
so
it is a bit technical.
Loan is very technical. So I think green loans, they run under that use of proceeds structure method.
Yeah,
and I think I think that I would have to read up on that a little bit more to see. Yeah. So PCAF does explicitly address this and has like guidelines around double counting for non-UOP investors and those with UOP. And then there's an effect on that on the attribution factor, but I don't have the formulas in my head. So if you don't mind,
so have they published guidance? Have they?
There is there is something there. There is a little bit of guidance out around it, but it's very specialized. So the PCAF released something in the beginning of December last year, I believe, and
yes.
I think it's like part A version 3 or something like that. And there was a lot of detail that went into that. But again, I don't have all of that in my head. I'm sorry.
Okay, no, that's all right. Thank you. I know that was a curly one to throw at you. Thank you.
We'll be researching that one, I think, straight after the call. We'll get back to Louise on that one. But thank you, everyone. Thanks for a wonderful session. Always good when we run these and everyone stays for the entire thing. It's great to see the attendees numbers stay constant throughout. Thanks for spending your lunchtime with us on this Wednesday. Arne, I'm sure we'll have another couple of webinars coming up in the next few weeks. They tend to keep popping up, so we'll make sure everyone on the call is well aware of them, and we look forward to talking at everyone about emissions in another couple of weeks. Thanks, everyone, and have a wonderful afternoon.
Thanks, everyone.